great disinflation?
Well, I can explain the disinflationary period, and I have to stress everybody who listens to your radio show today has a higher cost of living today than in 1980. I hope this is well understood. There was disinflation. In other words, consumer prices continued to go up, but at a slower rate. And there are several explanations for this. First of all, the Kondratiev, which is a price cycle, peaked out most likely somewhere in the 1970s, and on the CRB, which is a broad-based commodities index, in 1980, and then started to go down. So there was a tendency for at least commodity prices to ease in the 1980s and 1990s. Secondly, we had the opening of China, which initially had very little impact. But by 1990, and especially after 2000, China became a huge export machine and produced goods more efficiently and more cost effectively than other countries. And so consumer goods, at least what you buy, durable goods and so forth, went down in price, or at least didn't go up. But what has kept on going up are prices for insurance premiums, for health care, education, which is a very important portion of your disposable income.
You've been very cautious on this. You've called it the gloom for years, and yet there seems to be a resiliency to the global system. What's pushing against Marc Faber? What are the institutional forces that keep these economies going if you're calling for an unraveling of the economy?
Well, basically, I have not always called for an unraveling of the global economy, because I wrote the book, Tomorrow's Gold, Asia's Age of Discovery, in 2001. And I was very optimistic about the Asian region. And by and large, I'm still optimistic about the Asian region, and I'll explain this later. But the fact is simply, since you touched upon this discussion about Goldman Sachs saying Morgan Stanley is wrong, I think both of them will be right at some stage, and both of them will be wrong at some point. The key as an investor is to know when Goldman Sachs will be right and when Morgan Stanley will be right. Because you can have, in an economy, some sectors that are deflating and other sectors that are inflating. Just before you broke the program, before you cited one of your analysts saying how the local taxes in Las Vegas and in New York and so forth and so on had gone up.
Right.
And this is some kind of inflation.
Well, you've got the idea here, Mark. Let's look at the litmus paper, the global economy, the euro-yen. You're clearly calling for, do I assume, a stronger yen and a weaker euro on this global instability and on a stronger Asia?
Well, I believe that in general we may have, for the next 3 months or so, some deflationary scare, because if you look at how the mood and the psychology has shifted over the last 2 years, we went from a psychology of inflation, especially after the first rate cuts in September 2007, which then drove the CRB from 320 to 473, and it then peaked out in July 2008, in other words, a year ago, and then it crashed by more than 50% down to less than 200 earlier this year. And now it's been rebounding. And so at that time, until July 2008, we had a psychology of inflation. And then at the end of 2008, we had deflationary fears. And interestingly enough, the dollar was strong in 2008, whereas it was weak between 2002 and 2008. So now, recently, and this is important to understand the relationship between the bonds market, the stock market, and the currency market. The dollar was strong until March 4 of this year, and then as it began to weaken, the stock market started to shoot up. So if someone comes along and says, oh, the dollar will be a very strong currency, then I would argue, yeah, if you're right, you have to also think consequently that the stock market and asset prices will come down.
Well, are you predicting soon here that we will see a breaking of the dollar? Like if you look at DXY, are we going to see that get way through the lows of 2008?
Well, as I said, I think for the next 2-3 months, the dollar could surprise on the upside because whereas the psychology for the dollar was very bullish until March, now it's turned very negative. And so as a contrarian, you could say, well, maybe the dollar rebounds somewhat. But what I want to say to your listeners is that if I were an American, I would diversify my assets into foreign currencies and into hard currencies such as gold, silver, platinum, palladium. Because in the long run, the U.S. government is going to destroy the value of the U.S. dollar. I don't know whether it will be tomorrow, unlikely tomorrow, but in the long run, the dollar has already lost 95% of its purchasing power since the Fed was introduced, and that took 100 years. But the next 95% loss of purchasing power will not take 100 years, maximum 10 years.
Which foreign currencies?
Well, I would say the Singapore dollar is a currency that has at least a government that is honest. And when things go bad in Singapore, the government tells the Singaporean, you all have to tighten your belts, things are bad, we have to hold together, and better times will come again. But it's not the constant BS that the U.S. government tells its citizens that through government spending you can create prosperity and through money printing you create prosperity. Because if money printing would create prosperity, Zimbabwe would be the richest country in the world.
Well, Marc Faber, thank you so much. It is the Gloom, Boom, and Doom Report. Marc Faber today coming to us from Chiang Mai in northern Thailand. And Ken, the opinions there of Dr. Faber, something I think we've consistently heard from him is less the timing, but more the directional trend. I'm looking here, Ken, at a chart of the debt buildup in the United Kingdom, and it is absolutely remarkable to go back to the 1990 period and see the unusual times we're in as their debt breaks out to new highs as a percent of their GDP. The same idea here, and some of the concerns and worries out there. I'm sure we'll get a lot of emails on Dr. Faber's appearance.
Well, one of the things we got into with Marc Faber is I guess you call it the clash of the titans, Tom. We have a major disagreement here between Goldman Sachs and Morgan Stanley. Joachim Fels, who's the co-chief global economist at Morgan, sees a risk the Fed will keep interest rates too low for too long, therefore inflation later on. Ed McKelvey at Goldman says those concerns are overblown and the Fed has plenty of time to avoid that situation.
Yeah, Scott Lamon and Steve Matthews doing a great job with that story. And just the tension here on inflation and then how it plays into quantitative easing in the policy. Just two very sharp research notes recently from Joachim Fels and a very lengthy note from Ed McKelvey. McKelvey puts the pullout, the amount of money that the Fed's going to have to take out of the system, at about $875 billion on a net basis. Not as big as really I expected to see, but needless to say, an interesting report. Folks, you can see Scott and Steve's story. Goldman says Morgan is all wrong about Fed's quantitative exit. You can see that at Bloomberg.com and, of course, on the terminal under Top Go.
There's more television and radio news at Bloomberg.com. Stream it live. Download it to your iPod or desktop. Copyright Bloomberg LP 2009.